I'm going to talk about commercial property. I'm fund manager to Custodian REIT, which was established in March 2014. And as we say here, everyone has to have a mission statement. This is ours. We aim to be the real estate investment trust of choice for private and institutional investors seeking high and stable dividends from well-diversified UK real estate. So what's the background? Where have we come from? How do we get to where we are? What do we do? What makes us different? Everyone likes to say why they're different. Lots of reasons that we're exactly the same as a lot of others in our peer group, but there are a few subtle differences, and I'll try and draw those out as we go through. We listed on the main market in March 2014. We came to market with a history, with a pre-public history for 12 years prior to listing. We had been buying commercial property for the clients of Mattioli Woods, who are an AIM-listed wealth management group. I'm employed by them. We are the property fund management arm of the group. And we had about £100 million of property, in fact £95 million worth of property, net value 78 million. And we had 1,200 of our wealth management clients invested in syndicated structures owning those assets. Those structures were looking a little bit admin heavy, a little bit lumpy, and not really in tune with the direction of travel of regulation, particularly around, and as here, this is rocket science, particularly around non-mainstream pooled investments. So we asked our investors if they wanted to sell their properties into a new company, Custodian REIT, which we listed and raised 55 million at IPO. So we've gone in 3.5 years from 78 million of net value to 425 million pound market cap today. So significant growth, but never through the period of that growth have we lost sight of our principal objective, which is stated here on this slide. Fully covered dividends, income, income, income. Property is an income-bearing asset. Income drives 80% of total return from property investment over the long term. So it makes complete sense to us to have a strategy that focuses on income. How do we go about that? And we'll go into this in a little more detail as we go through, but we do it with low gearing, and we do it by targeting a regional portfolio of what the market would call smaller properties. That's sort of sub £10 million. So these are not corner shops. These are still mainstream commercial properties, but they're not the 10, 50, 100 million pound assets that are all around us this evening. Our target audience is very much discretionary wealth management and private high net worth investors, so I hope this is interesting to you. First 3 years of trading, 10% share price total return per annum. 3 years ago, people said, yeah, we like what you're doing, but a bit boring. Boring's quite attractive now. And I think as we go through what will almost certainly, whether you're a good or a bad Brexiteer, will almost certainly be a turbulent time, owning real assets that produce a high level of dividend secured against contractual income is going to be very appealing. We have, unlike a lot of our peers, grown our dividends annually, so from 5.25 pence at IPO through 6.25, 6.35 and 6.45 pence per share today, based on today's share price, because we are trading at about a 10 to 12 premium to net asset value. That gives you a dividend yield of 5.5%. So even though we're at a 10 to 12 premium, it's still a relatively high dividend amongst our peers. And we've done this without the volatility that others have seen. And what this chart looks at is the total shareholder return, 12 months either side of the EU referendum vote, which you can see is here. Now, the light blue line represents Custodian REIT. The dark blue line represents the aggregate of our peer group. And we've listed the tickers of our peer group down here. And these are all property investment companies. And you can see we had a much smoother ride through the turbulence around the EU referendum. Now, broadly, we've all ended up at the same place. I'm not suggesting for a minute that we have massively outperformed, but I think we've had a more comfortable ride. And for a lot of our investors, that's very important. Why did we have that more comfortable ride around the EU referendum? I think there are a number of things. Firstly, we've got an entirely regional portfolio that feels less exposed to some of the Brexit risks that are perhaps more prevalent if you own City of London offices. Secondly, we have a relatively high dividend, and in times of volatility, is it the part of your portfolio that's delivering stable, high level of income that you're going to fiddle with, or is it the bits that feel perhaps more exposed to financial markets? And I think thirdly, and very importantly, is our shareholder base. It is, as I said, discretionary wealth management, high net worth investors. And the reasons for investing are often very different to institutional investors who might be investing as a result of an edict from on high to either increase or decrease weightings to real estate. People are investing for the long term. And of course, that's the right way to invest in real estate. Numbers I won't bore you with. Some of them we've talked about already, but they will be in your pack when you get that. And we don't just buy properties. Yes, we've grown the portfolio significantly. Obviously, we manage the properties as well, and that's something that we do directly. We manage all the properties in-house. We think it's very important to have that one-to-one relationship with each and every one of the tenants. So we collect all our own rent, and the good news is that the market in the regions is pretty confident at the moment. There is a shortage of supply of new buildings. Tenants are keen to hang on to the buildings that they've got, and there is a broad acceptance that rents are growing. And that makes our job at the moment very much easier. So the purpose of this slide isn't really to say, look how clever we are. We have delivered 8.9 million of management-led valuation increase. What it tells you is that the market is allowing us to do this. Because if the market was moving against us, we wouldn't be able to deliver rental increases, we wouldn't be able to extend leases, and we wouldn't be able to keep our occupancy level at the sort of 97, 98% that it is. And sometimes we sell. We're not traders. So out of a portfolio of 480 million as it is today, in the last sort of 12 to 18 months, 24 million pounds of disposals. So not significant. Why do we sell? We sell either because there is a special purchaser, very often owner-occupiers, who are prepared to pay a price that is well ahead of valuation and well ahead of the valuation that we would be prepared to hold the property, or because the property no longer fits the long-term ambitions of the fund. And you don't always get it right. Sometimes you think it's going to go one way and it goes the other. But happily, we don't do a lot of trading because trading is very expensive. You know, in and out costs of buying a commercial property are about 6.5 on the way in and about 2-ish on the way out. So 8.5% trading costs means that even if you hold properties for 3 to 5 years, you've got to outperform your standing stock by 2 to 3% per annum. And that's tough to do. So we buy properties that we don't want to sell and that we feel we can always re-let. So some of the key characteristics of the fund, and I accept that these charts are perhaps a little bit difficult to see, but this is Custodian REIT here, and this is dividend yield. You can see, so amongst our peer group, relatively high, and importantly, fully covered, because the bar on the far right, while they pay a higher dividend, it's not fully covered. And fully covered dividends is really important, because it means they're sustainable. It means we'll be paying them this year, next year, and for many years to come. Volatility, we've talked about already, and a much lower volatility than our peer group. And gearing, I suppose, is another key differentiator. We have a target gearing of 25%, currently 20%, but we've taken advantage of the long-term low cost of fixed-rate debt. And we fixed 3 tranches of debt for 10, 12, and 15 years, which is giving us a pool of debt that has an average unexpired term of 10 years and an average cost of debt of 3.1%. And that's fixed. And you set that cost of debt against a portfolio that's yielding 6.75%, you can see that there are some very real advantages to having gearing in the portfolio. Why now? It's a good question to ask. It's perhaps a better one to answer. And I think it would be very easy to look at the market, particularly sitting as we are in central London, and feel, yeah, no, property's had a good run, but maybe this is now not the time to get in. The problem with any objective look at the property market is the statistics are heavily skewed by central London. Central London makes up about a third of the total investable universe of commercial property. It's probably 90% of all commentators on commercial property, and it's a significant percentage of all property investment businesses, all based in London. So you get a different view. But I would say that out in the regional markets, the occupational market is mid-cycle. Now, capital markets sometimes run ahead of occupational markets, but there's a shortage of supply caused by what was in the regions an 8-year recession, not an 8-month recession that we had in central London. And through that period of recession, there was no development. Anything that had been built in 2008 has subsequently been let. So you will not drive around the country and find empty office buildings and empty industrial buildings with a to-let board swinging in the wind, waiting for a tenant to turn up. And that lack of supply is causing rental growth. And the stats here, this is industrial rents. They're growing most strongly. Industrial and logistics, and I think we might have some business to do on the logistics front after this. I think you said you wanted some sheds in the Midlands, so that's good. I'm sure we can help you out there. Retail warehousing, this is out-of-town shopping, so where you will find B&Q and Wickes, but you'll also find Home Bargains and B&M Bargains and Poundstretcher and Poundland. And that's a really interesting bit of the market. I think it would be very easy to look at the physical retail market and say the internet is going to kill shopping. Well, firstly, I don't hold with that. It's the nation's favourite pastime. Second favourite pastime, I understand, is angling. So if shopping is no longer the nation's favourite pastime, then angling is top of the list. And I don't think any of us could live in a country where angling really was the nation's favourite pastime. But also the data tells us that 80% of retail transactions touch a physical store. Either you go into store and buy in store, or go to into store, then buy online, or look online and then click and collect in store. And it's this out-of-town market that is perhaps most complementary to the growth in online retailing. Complementary because either it's uncorrelated because the stuff you buy in these out-of-town retail parks you wouldn't buy online, a bed, a bath, a bag of cement, a bag of nails, or because it's the value impulse purchase that you would get in B&M Bargains or Home Bargains. You're not going to go online to buy 3 Mars bars for £1, but if you're walking down the aisle, you probably will put it in your basket. And those value retailers have done really well, and there's been significant growth there. And we're now seeing in those out-of-town retail parks record low vacancy rates, also driven by a very restrictive planning regime because the planners are very keen to protect their high streets. And of course, it's these retail warehouse units on retail parks with free parking that is exactly where you go to for click and collect. So even if you buy from John Lewis, rather than going to Oxford Street and picking up the bag and taking it home on the train, you can get it delivered to your nearest Waitrose, drive to the store, park for free and pick it up. So that out-of-town retail market is doing well, and it's been a focus for us. We've grown our portfolio allocation to retail warehousing significantly over the last few years. And just before we move on, and I have moved on, just before we move on from rental growth, you can see this is central London office rents. We're starting to see they've come off. And there is some concern both around the Brexit effect, but also we've got a pipeline of development that started 3 years ago that is still being delivered upon. So we might see a little bit of an oversupply there. But that's not Custodian REIT. We are a regional portfolio. So we've talked about some of these things. So clearly I'm ahead of myself on the slides and not doing badly on the time either, so I'll keep going. Lack of supply, limited speculative development. You know, the banks still are not supporting speculative development. And when you've got a market that is driven by a demand and supply imbalance, as all markets are, that's delivering rental growth, if it is excess demand, a shock, although the market doesn't seem to be reacting to shocks at the moment, because nothing Kim Jong-un can do or Donald Trump can do or Brexit negotiations can do seems to affect markets. But if we had a shock, demand comes back, you're back into balance, rental growth stops. But we've got a market in the regions that's being driven by a lack of supply. Demand is okay. It's people coming to the end of their leases, businesses quietly growing, logistics businesses taking sheds from me in the West Midlands. Whatever it is, just gentle growth, reasonable turnover levels of demand. But that lack of supply, the only way to fix that problem is to develop. Firstly, that takes time, and secondly, it requires financial support from the banks. And the banks really aren't there yet, certainly not for speculative development. So I think we've got a way to go. And the other interesting driver of growth is that through the period 2008 to 2014, when rents were falling in nominal terms, let alone in real terms, so rents are now very low compared to where they were in real terms. Through that period of time, rents have fallen to a level that is below the level they need to be to bring forward new development. So let's look at an industrial unit. Rents in most regional markets are around about £5 a square foot. Yet if you want to build a new industrial building, rents need to be £6.50 a square foot. Otherwise, you don't generate enough value and the developer won't build. So not only do we have the demand-supply imbalance weighing heavily on the supply side, which is the right side, but we've also got this cost imperative that says, if you don't pay the rent, Mr. Tenant, we won't build it. So I think this rental growth has got some way to go. We're only 18 months, 2 years into a rental growth cycle. One of the things that's worth considering, although I think this is, I don't know why I have this slide, but it's here and I'm going to talk about it. It's a bad reason for investing in real estate just because it's the least worst alternative. But sometimes you've got to consider that. And what this chart is looking at is the light blue line is the average property yield versus the dark blue line, which is the 10-year gilt rate. And the shading is the margin between those two. That margin is as broad as it's been for a very long time. And in a low return environment, and if that's where we're heading for the medium to long run, then a high yielding property investment looks pretty attractive. The counter says I'm down to 3 minutes, so I'm going to rattle through a little bit more about Custodian. We've got 140 properties around the country. You can see the spread there. Give you an idea of some of the types of buildings we buy. It's all sectors, but it's all sub £10 million lots. And I'm going to dwell on this slide for a minute, apart from anything else, because it needs explaining, because it looks it looks rather gothic on screen. What it's showing is the net initial yield of properties traded in the market with a lot size of under 10 million, that's the light blue line, versus the dark blue line at the bottom, which is the lot sizes of over 10 million, and the shading is the margin between the two. So for 10 years, from 2000 to 2010, that margin was a pretty regular 50 basis points. So let's call that the risk premium. That's the risk premium for owning small lot size property. But what happened then? We've seen that grow to 169 basis points. Now, have we seen a change in the risk profile of small lots versus large lots? No, we haven't. We've seen a change in buyer attitude. So buyers of property, particularly the big unit trusts, overseas buyers, they're all focusing on larger lot sizes. So you've got excess demand for a relatively small supply of property versus the smaller lot sizes where we've got an increase in supply. So we can now buy property at 165 basis point margin over the large lot size, but the risk premium for 10 years was 50 basis points. So could it be argued, I would certainly argue, that we're getting 115 basis points for taking no additional risk? And it's that strategy that allows us to target a higher dividend than most of our peers. The spread of the portfolio weighted to industrial and logistics, and that's where we're seeing the rental growth. I mentioned it earlier, the growth in our exposure to the retail warehouse market, which is the second highest growth sector in terms of rents in the market. A relatively low exposure to offices. Those are expensive assets to own. As a landlord, you're forever refurbishing, and then tenants leave, and then the new tenant comes along and says, I'd like 2 years rent free, please. That's fairly unappealing from my perspective, but in some markets that still makes sense. I've talked about this already. We manage all our own properties, very high occupancy rate. I called it a vacancy rate before. And that's very pessimistic, isn't it? It's an occupancy rate. We don't talk about 2% vacancy rate. We talk about 98% occupancy rate. And that's pretty high, and I think that tells you a lot about the sort of properties that we buy. And this chart, which is, I'll probably finish on this, because the conclusion you can read for yourself, and this is the one that allows me to sleep at night. This shows you the amount of rent that is paid by any one of our tenants in the portfolio. And you can see our largest tenant represents only 2.3% of the total rent roll. So we are not exposed to tenant default risk. You know, if push came to shove, we could burn this. I'm not going to recommend this, but we could burn down our largest building uninsured, and shareholders wouldn't know the difference, because this is a very well diversified portfolio. I said I'd finish there. The time has just gone on to questions. So, any questions?
Any questions, anybody?
Gentlemen, just back there.
Who are your main big shareholders, and what percentage total do they hold?
Half of our shareholder register is still clients of Matt O'Leary Woods, advised clients of Matt O'Leary Woods who seeded the portfolio. And then we have Investec, Close Brothers, and a number of the other large wealth managers that you would know. And then a core of retail investors as well. We've got about 1,500 to 1,600 shareholders on the shareholder register. So it's a very well diversified shareholder base.
The total percentage of the shares you have on the market, how much do the institutions hold?
Oh, we see. I don't have that number off the top of my head, but it'll be about 30. And when we say institution, they're large wealth managers. It's not institutional investment. This isn't institutional pension money. It's all of us being represented by a discretionary wealth manager.
And what's the spread between bid and offer?
It's pretty narrow. It's pretty narrow. It's about a penny.
Thank you.
Any other questions?
How many people do you employ?
Yeah, there are. We've got a team of 15 to manage the portfolio.
How do you compare your custodian rights to other? There are a number of rights organizations, you know.
Yeah.
How do you compare them? Like New River rights.
No, well, I'm glad you asked. I mean, the easy answer is we compare very well indeed. There is a complication in definitions, and it's not a complication of my making, but I'll explain it. The REITs, as they like to call themselves, are the old listed property companies of old who converted into companies with REIT status, which is nothing more than a tax status, in 2007, 2008. And they are internally managed companies. We're a property investment company who also have REIT tax status, and we sit amongst a peer group of about 10 other funds. So we're externally managed, so we're an independent fund manager, and our close competitors are Standard Life Property Investment Trust, Picton, Eddiston, F&C Property Trust, and we are all of a type. We're the only ones who have the smaller lot size strategy, certainly in the sort of core to core plus quality of assets. Others operate in the smaller lot size arena, but are targeting more value add assets. So in my view, taking on more property risk to deliver ultimately no more return.
Then how long is your leasehold in the property?
The average unexpired lease is 5 3/4 years to the first break. But what we know is that 2/3 of tenants don't exercise their option to break when they have the chance.
And then when you distribute your dividend, you distribute in two forms: property investment, income dividend, and the other one is.
Yes, property investment distribution and dividend. It's mostly PID, property investment distribution. And we pay that quarterly.
Any other questions, anybody? I've got one just about your dividend. So is it 5% at the moment, approximately 5%, depending on your share price?
It's 5.5 pence it's 6.45 pence per share, which is a dividend yield of 5.5.
Of course, your share price has gone up in the last 3 years, I think 10% on average.
Yeah.
Are you going to intend to maintain that dividend at around the 5%? Depending obviously on your share price, it's going
Well,
to fluctuate a bit.
we've grown that dividend, and certainly we intend to continue to grow that as long as we can do it in a sustainable way. The dividend yield, of course, and maybe following this evening, it's going to go even lower.
Exactly.
Who knows?
More people buy the shares, the higher the share price goes up. Richard, thank you very much indeed. Thank you.
Very much.